to Advanced Option Strategies. This event is brought to you by Timing Research and Trade Out Loud. The event is being recorded, and all the recordings will be available as soon as they're processed, and they will be available on the TimingResearch.com website. David is going to come with more details on that. So both David Kosmeter and I will be your hosts today. My name is Anka Metcalf. So before we begin, we would like to remind you that all the information provided today is for educational purpose only. It should not be construed as investment advice regarding the purchase or sale of securities, options, futures, forex, or any other instrument of any kind. And trading involves a high level of risk and may not be suitable for all investors. You could lose money. So before deciding to trade, you should carefully consider your objectives, your level of experience, and risk appetite. Individual performance depends upon each person's skills, time commitment, and effort. Results may not be typical, and individual results will vary. So therefore, you must do your own research and make your own trading decisions. With us today, we have AJ Brown, and he is with TradingTrainer.com. It is my pleasure to present to you AJ. AJ, take it away. You have the mic.
Thank you so much. Woo! Good morning, everybody. Nice and early here on our Thursday morning here. And I've got a presentation that I'm going to be giving today. I wanted you to actually have some note-taking abilities there. It's called What to Avoid During a Market Drop. And this is all about generating serious investment income with options. So please have some pieces of paper. And I notice I said plural, pieces. And give me a pencil, or if you feel really confident this morning, have a pen. But I want you to take some notes the old-fashioned way. Here we go. I got some facts for you here. Number one, what's happening in the world with people getting sick and with people, upset and, protesting, even bringing it to the point of violence and loitering with all the different things that we hear about, people getting hurt while getting stopped by police and things like that. It sucks. And I'm not going to even try to sugarcoat that. That sucks. But what's happening in the markets at the same time with the volatility, the ups and downs, if it's played right, it can actually set you up for months, if not years to come. What happened about 3 months ago set up a lot of my traders for at least the next couple of years. And what's been happening recently with the Fed buying all kinds of junk bonds and individual corporate bonds, talking about that, bringing the market up, even though it's not matching what's happening in the economy, that's also been setting us up for years to come. It's about being on the right side of the equation. So instead of sitting there and allowing your investment income to be whittled down, if you're on the right side of the equation and position yourself correctly, you actually are in for some windfalls. And at the last point I have, a lot of us are looking for things to do right now. We're being forced to take some time off. We're trying to get back to work, but maybe that's not possible, or maybe you're retired or whatever that scoop is. But a lot of people are staying away from other people and they're looking for things to do. Now's the time for us to figure out how to make our investment dollars really profit, not lose. We've got this extra time. Now's the time to really pull this up. And these are all just facts. Now, I want to give you the second most common error that investors make. Now, a lot of you might resemble this. A lot of you might know investors who have done this, but this comes to me, if I had a nickel for every time somebody comes to me with this, first we must recognize the patterns that we're seeing. These are patterns in price, panic and fear versus confidence. That's another an easier way or more descriptive way to call something called implied volatility. Time curves. You have to pick up those patterns first. I call that pattern recognition. And the folks who come and work with me, we always talk about pattern recognition specialist. That's what you want to aim to be first. And then second, we use the tools that we have, like the option trading strategies, right? You always wonder why people get interested in options. Well, if you think about it, if you're only interested in stocks or commodities or even Forex, then what are you interested in? You're either interested in buying or shorting, two different strategies to profit on directional moves. When you get into the realm of derivatives like options and futures, there's 27 different ways to profit on market moves using options versus just two. And a lot of them have nothing to do with directional moves, and that's what we're going to be talking about today. So you use the tools that you have. If you have options, you have quite a bigger tool chest than if you do something else to profit from those patterns we recognize. We call that pattern utilization, but it's got to be in that order. Here's a story that I hear so often. AJ, so I learned from this person XYZ, and I learned how to do and fill in the option strategy of that's in vogue for the moment there. So say, for instance, I learned how to do vertical spreads. Okay. I was doing really well for the first 9 months. I was making, single digits, if not double digit returns on my portfolio for the first 9 months. And then in the 10 month, I don't know what happened. Right there, that's a red flag. I don't know what happened. But not only did I lose all the gains I made for the first 9 months, but I also lost a good chunk of my portfolio. Right there, you can tell that the person wasn't paying attention to the patterns, and instead they were applying the same tool, in this case, vertical credit spreads, to whatever pattern was presented to them, no matter what, right? And you could tell that just when they say, I don't know what happened. Well, that's because you weren't recognizing patterns. So do make sure that you're not reversing these two steps, that you're not using a option or any sort of trading strategy methodology that is a tool to profit from patterns without first making sure you're clear on the pattern you're applying it to, right? The fastest way to suffer trading losses is to reverse these two steps. Now, I said this was the second most common error that investors make. Would you guys like to know what the first most common error that investors make? Sure you do. So make sure this is make sure you're taking notes right now. We only invest the amount specified when we take the maximum allowable risk to our portfolio, and you set that, right? The maximum allowable risk. What will you open your portfolio to be suffering on any sort of max losing trade? I tell my folks to set that somewhere around 2%. That means you would have to do 50 really crappy trades in a row to wipe yourself out. None of this stuff where somebody comes and says, and then I lost not only the gains that I made the first 9 months, but a good chunk of my portfolio. That tells me right then that you're also suspect in making the first most common error that investors make, which means you're not setting the max allowable risk to our portfolio and dividing it by the maximum trade risk. That means you have to plan your trade in advance. You might have heard this a million times, which is we plan our trades and then we trade our plan. But when I sit down and look over a lot of investors, especially newbie investors' shoulders, I find that indeed they're not actually planning their trades. They think they are, but they're not planning their trades. Planning their trades means that you understand the risk that you're taking on, right? So it's a mathematical equation. You take the max allowable risk to your portfolio and you divide it by the maximum trade risk, and that's going to tell you what your position sizing is. I'll say, hey folks, what's your position sizing? And they say, well, when I was starting out with vertical credit spreads, I wasn't very confident. And so I put in a certain amount, but as I kept going every month, I got more and more confident. So I put more and more of my portfolio. I'll tell you, the market doesn't give a flick about how confident you are. And if that's your guidance for risk, you're following a flawed plan. Another one I hear is, well, I had lost on a previous trade, so I was trying to make it up. The market doesn't give a flick about how much money have you lost. And if that's the way that you guide your risk, then again, you're following a flawed plan. It comes down to a mathematical formula. And that is, take your max allowable risk to our portfolio, a number that you set, and divide it by the maximum trade risk that you figure out when you plan your trade. This is all done before you place the real trade. This is the first most common error investors make. It's ignoring proper risk management. My other favorite one is, oh, I just set the risk based on what this guru told me. He said use 10% of my portfolio. Again, the markets don't care what your guru says. Set your risk based on this simple mathematical formula. Yeah? Okay, we've got that out of the way. How many of you actually know who I am? Some of you have heard me speak before. Some of you have worked with me before. Some of you have no idea. Okay. So I'm AJ Brown. I founded this company, as they mentioned in the beginning, called Trading Trainer. People call me the world's most disciplined option trader. I think behind that my back, they call me the world's laziest option trader. I think I prefer the world's most efficient option trader. That's because I like to take the least amount of money, least amount of my energy, least amount of my time to get from point A to point B to make the most profit. I've been doing this since 1997. I opened up my school in 2002 where I publish my daily insights for my members 5 days a week. And very shortly after 2002, I have this wildly successful ebook that I find on pretty much any successful trader's computer called The 7 Strategies of Successful Option Traders. Also, I see this home study course that I put out on people's shelves all the time. But my thing that I'm most proud of is my foundation. So I always like to take a moment during these presentations and tell people about my foundation. So at the same time I started my trading trainer school to teach people how to trade options, I also took some kids off the street of Aurora, Colorado, outside of Denver, not a very nice place. I took 9 of these kids, and they, of course, they didn't have computers. They were high school age, but I'll be honest, the school system was just pushing them through. They probably had about a 10-year-old or a 4th grade education, but they were already, on their way to graduating high school just because the city wanted them off their books. No computers. At that time, this is 2002, 2003, our fastest speed internet connections were DSL. How many of you, with a show of hands, you remember DSL connections? Some of you might even still have them, depending on where you are in rural America. We had to go to the library in Aurora, Colorado to do this. And at the time, they were not letting us on the computers for any more than 30 minutes a day. So I took these kids with a 4th grade education, using the computers only 30 minutes a day. And we taught them the same strategy that I'm teaching today. It's worked time in and time out during the 2008 sell-off, during the most recent sell-off. At the end of the 6 months of working with these kids, I thought, well, I gave them each $2,000 of my own dollars, thinking I'd never see it again. Playing money, right? I'll have you know that every single one of those kids took that money and wound up paying me back shortly after. They all wound up getting computers, getting themselves off the street. One of them actually brought themselves through Denver University. He's a father now with a university education. I keep up with all these folks. They're not kids anymore. Anyway, huge success story. We have been continuing with this foundation every year. In fact, we moved from Denver to Southside Chicago. You might have heard about that in the news. A lot of people talk about Southside Chicago. It's a very rough area. Last year, we graduated 170 kids from our program. So I'm very proud of that. So let's get back to what's at hand here. I always like to ask people go through this mental experiment. You've probably already done it before, but just play along. Would you take $50,000 today Or if I offered you a penny that doubles every day for a month, which would you take? Well, let's go through the math. So if you took that penny, gosh, a week is about 1/4 of the month. You'd only have 64 cents. And you've been putting in, it takes some effort to double your money, right? So you've been putting in a lot of effort and not much to show. And I'm starting to think that maybe the $50,000 was a better idea. Okay, so we're at day 10 and we have $5.12. We're about 1/3 of the way through the month. We've been putting in all that effort to double our penny every day, and we still have nothing close to that $50,000. All right, I'm about halfway through the month. I have $163.84 to my name. I've been working every day at doubling that penny, and I'm thinking, boy, that $50,000 sure does look good, and I'm already halfway through that month. There's no way. Let's keep going. All right, I'm 3 weeks into the month, and now things are finally starting to look up. 3 weeks is just about 3/4 of the way through the month, just a bit shy of that. I have $10,485.76, but boy, it's been a long journey to get here. Let's keep going. All right, at day 24, I'm over 3/4 of the way there. I'm just about $83,886.08. It's finally starting to pay back. All that consistency paid back. By the way, that's the number one thing I found with a lot of folks. A lot of folks find something and they have like what I call shiny object syndrome. They don't stay consistent with any one thing. They keep jumping from thing to thing. Consistency is the winner. If I keep going, look what happens in that last few days of the month. I end up with the month with $21,474,836.48. I'm so thankful I didn't take the 50 grand, but boy, was it a journey over that month getting there. In fact, this is what we call compound interest. Not sure if Albert Einstein actually said this. It is attributed to him. Compound interest being the most powerful force in the universe, and it is. If you earn, this is something I did early on. I said, well, I know that I can't double my penny every day. I mean, maybe I can have a doubling investment every once in a while, but consistently every day. But what if I just wanted to double my portfolio every year? Much more doable versus every day. In fact, if you reverse engineer that and you just do some simple interest, not compound interest, if you earn 6% on your money every month, guess what? Your investment will more than double every year. 6%. So I aim for the moon, and if I get to the stars, that's great. But my number is 6%. I know a lot of people talk about doubling and tripling your money every. Let's just focus on 6%, because on 6% we can double our investment every year. So if I have $1,000 right now, it means in 12 months I'd have $2,012. 2 years, I'd have $4,048. 5 years, I'd have close to $33,000. And in 10 years, I'd be a bona fide millionaire. But the scoop is, I like this even better. If I have a $100,000 portfolio, by just focusing on 6% every month, I can generate $101,219.65 per year. Now, almost all of us, even if you have a bigger family, can live on that, right? And that's more money than is the mean salaried income here in the States. Now, of course, if you live in the LA or San Francisco or New York or Chicago, it's a little bit more than that. But the mean income for a salaried worker in the United States is $87,000. And that's somebody who works 60 hours per week. Now here we're talking about making your investment dollar work. The difference between an investor and an employee. Make your investment dollar work, focus on just that small target of 6% every month, and there you go. You make more than the mean white-collar salary of the United States. So let's do a little quiz here. I want to make sure you were paying attention up to this point. What minimum returns must you make monthly on your portfolio to more than double your money annually? 0.5%, 1.5%, 6%, 5%, 6%, or 10%? Now, if you're saying to yourself 6%, then you were paying attention. If not, just take a note. So what are we actually investing in to get this 6%? You want to write this down. We're selling theta decay optimized option premium. What does that mean? It means that we're profiting on time passing by, and that's a very reliable variable in options right now. Folks who are investing on directional moves and folks who are investing in implied volatilities, if you haven't noticed, it's really quite a crapshoot right now. You're all at the whim of the news announcements, mostly from the Federal Reserve. Also some news announcements about any sort of pandemic going on, right? It's very difficult to do any sort of predicting. Fundamental analysis, for the most part, throw it out the window. It's not going to help you right now. But time passing by is a very reliable variable. In fact, if 60 seconds doesn't equal a minute, and 60 minutes doesn't equal an hour, and 24 hours doesn't equal a day, 7 days doesn't equal a week, 365 days and a quarter doesn't equal a year, if one of those is off, we have more to worry about, I'll tell you, than investing, right? If one of those is off, our planet is out of whack, right? So, okay, I said option premium. What the heck do you mean by option premium? Well, if you ever look up an option price on the big board, right? If you say, I'm going to the CBOE website or the NASDAQ website and you pull up an option price, that option price is actually equal to two components. One of them is called the in the money value. For you academics out there, you could also call that the intrinsic value. And the other one is called the premium value. And I also, the academics out there will call that the extrinsic value, intrinsic and extrinsic value. Some people will call the premium value the time value. I hate that term. I've always hated that term. That's kind of the nerd in me. But time, that premium composes so much more than just time. But I like to call it in the money value and premium value. Add those two together and you'll be able to get the option price. Well, some of you are probably saying, hey, I'm really interested in options. That's why I'm here. But can you give me a quick understanding of what it is? Well, options are these financial instruments called derivatives. They're actually contracts between buyers and sellers. They're typically bought and sold to hedge some risk against the stocks and index and exchange traded funds out there. But that's not how we're using them. Again, we're selling the premium. So how do you do that? 4 simple transactions. You want to get your pen or pencil ready right now. We want to write some covered calls, or even better, how about writing some covered puts? We like to flip the covered call upside down. Today, I'm going to also talk to you a little bit about writing covered calls against leaps. In other words, supercharging your covered call writing. This is, again, for you academics out there. These are called bull call diagonal debit spreads, and they're fantastic. And there's a flip side. We can write covered put against leaps, supercharge our covered put writing. This is our bear put diagonal debit spreads. Now, let me just have you mark some of these. The first, writing covered calls. The third, writing covered calls against leaps, the bull call diagonal debit spreads. And the writing covered puts against leaps, the bear put diagonal debit spreads. They're all considered what we call cash trades. This writing covered puts is called a margin trade, and it requires a margin account. What's nice about those 3 cash trade variations is that you can do them in a tax-free or tax-deferred retirement account, which is what I do all day and all night. A lot of my program participants do as well. tax-free if it's at all possible. So keep that in mind. So let's run through an example. I actually pulled these prices at the close of yesterday. Market hasn't opened. It'll open in 5 minutes. But as of yesterday, GE, a pretty popular stock, was trading at $7.24. And the GE July 17th, 2020, $8 call was selling at 29 cents. So if I buy GE and then sell back that 29-cent call, by the way, I'm not saying that GE is the best stock to do this. And what we are demonstrating here is called a buy right covered call. I just want to get the point across. A lot of our folks, in fact, mostly what we do is called legging in. So we get better numbers than what I'm about to present to you, but I'm distilling it down to a very simple example. So if I buy something for $7.24 and then I sell back, it's almost like when local vendors give you a coupon. I'm giving this buyer a 29-cent coupon, and they have until the expiration date, July 17th, to use that coupon. Otherwise, it's worth nothing, right? It's kind of like I bought GE at a discount. I pay $7.24 and I get 29 cents off. I get an instant dividend of $29 per option contract sold. That's because options come in lots of 100. So, okay, what happens if GE closes above $8 on July 17th? All right, let's run through the math. I paid $7.24 for GE. I get $8. So I make 76 cents per share profit there. Plus, I get to keep the 29 cents I made for selling the call option. In other words, I make $1.05 per share. I get a profit of 15.1. And now, again, I'm telling you that this is not even the best trade out there, but already I've set myself up for much better than 6%. In fact, just as a side note, the folks that work with me are doing much better than 6%. They're getting closer to 11, 12, even 13% per month, even during the downturns that we've got going on right now. If you're making 11, 12, 13% per month, it turns out you're doubling your money every 5 months, not every year. Just a side note there. Okay, what happens if GE is flat by July 17th? That means you got $7.24 in. You made 29 cents. You've got a total accrued profit to date of 29 cents, and that's 4.2% on your cost basis. But here's where you're going to do it again and again and again. And this is actually what we like. We like to have it because it becomes very simple. We keep the GE, and it's like you're renting it out. Every month you're collecting 29 cents, 30 cents, whatever it is that month. You're collecting the rent for the month of just owning the stock. But you don't have to deal with things like tenants, trash, and toilets, like when you have to rent out a real piece of real estate. What about GE dropping by July 17th? So, okay, this is kind of neat. $7.24. Don't forget, I got a discount of 29 cents on there. That means my profit buffer is 29 cents. My break-even price now is $6.95. GE would have to drop all the way to $6.95 for me to have any sort of risk in this trade. In fact, I'm going to show you in a couple minutes how we can even hedge the risk, nip it right in the bud, even better than this. But this strategy has a built-in profit buffer. Here are some examples. I'm not going to spend too much time on my examples. 17% on Micron, 12 trading days when the stock traded up. 15% on Activision and 34 trading days when the stock traded water. 14% on Allscripts Healthcare and 86 trading days when the stock took a big old dookie. My trading software on my other screen just went off. Market's open. Answer all that apply. What does investing by selling premium create? Does it create an instant dividend? Does it create a discount on a security like an index, ETF, stock? Does it create a profit buffer? is it like an expiring coupon? If you're thinking to yourself, all of them, then you're right. So let's keep going here. 21% when the stock traded up, that was Caesars. 12% when the stock went sideways, that was St. Joe's. 17% on Community Health, and 81 days when the stock took a dump. So now I'm going to ask you a question in advance to see how much knowledge you actually already know. How can we lower how much we pay in the investment, increase our returns, and even convert a margin trade into a cash trade so we can do it in our tax-deferred, tax-free retirement accounts? Should we sell out in time options? Should we replace the security with an option trading at parity? Should we just give up and buy mutual funds? This is too complicated. Or is what we're talking about not even possible? What do you think? Type the answer into the webinar chat if you'd like. If you came up with replace the security with options trading at parity, you're absolutely correct. So let's talk about that. Option premium is the most when an option is at the money. When we go deep enough in the money, the option actually winds up having very little premium. In fact, we like to target less than 5%. And what's left is almost completely intrinsic value. In other words, in the money value. In other words, if we go deep enough in the money, the option now behaves exactly like the underlying security. Some experienced option traders like to say, we turn our option into a one-dimensional trading instrument, right? We get this thing to move dollar for dollar. In other words, if the underlying symbol goes from $100 to $102, our option goes from $10 to $12. It moves dollar for dollar, right? And this is what we call options trading at parity. So the rule of thumb is we go deep in the money. We get that dollar for dollar movement, but it's at a cheaper price. So you might say, okay, I can go deep in the money, but how far out in time should we go? Well, we want to buy that back month option far enough out in time so that the substitute option expiration is not going to interfere with selling many cycles of premium, right? We're going to be renting out this back month option just like we would a stock, and we want to collect many months of rent. We don't want to have all of a sudden, it would be like owning a piece of real estate, having tenants in it, and then all of a sudden having it disintegrate and your tenants are like, well, I guess I'm not going to pay you rent anymore. We don't want to have that happen. So we have to go far enough out in time so that option expiration, generally that number is about 6 months out or more. Write that down. And we like to use option leaps. The reason is because leaps have liquidity, and liquidity is important in doing any sort of trading. We don't necessarily have to use leaps, but leaps usually have a lot of liquidity. So what if we take our example of GE? Remember, this is just an example. There's better symbols out there. There's better ways to do it, but this is just a bare bones. I could do GE, or I could do the GE January 2021 leap, the $3 call. I either pay $7.24 or I pay $4.37. This option, by the way, that I selected has 97% in the money and only 3% extrinsic value. So for all intents and purposes, it's trading at parity. GE moves up $1, so will that call option. All right, so instead of the $7.24, we're paying $4.37. We still sell that 29-cent call that's near term. We get our instant dividend of 29 cents per option contract sold. If GE closes above $8, let's go through the math. We bought the back month option for $4.37. we get $5 for cashing it in. Does everybody understand why? Because I get exercised at $8 and I exercise at $3. I keep the spread, hence the name diagonal debit spread. I keep the difference between the two strike prices, which is $5. 8 minus 3 is 5. That gives me a 63-cent profit. I also keep the 29 cents. Just want to verify you guys can still hear me. I'm going to assume you guys can. Good. Thank you. Thank you, everybody. All right, 29 cents. That gives me 92 cents of total profit, which comes out to 22.5% ROI. Again, I could leg in and get even bigger numbers, but this is a fantastic trade. In fact, if you're not just looking at doing this simple trade right now, just take it back, do some research on your own on GE. By the time July 17th rolls around, you know, you could be very happy. What if GE is flat? Okay, I paid $44.37 for that back month option. I get my 29 cents. I keep my 29 cents. I made 7.1. Even in this case, I'm already making more than 6% per month, and I'm going to do it again and again and again. I'm just going to keep every month selling the near-term option, and as it expires, if it's flat, in fact, this is the ideal case. This is called a range-bound option trading strategy, and this is the ideal case. What if it drops? Same thing. I've got that profit buffer built in of 29 cents. It can go all the way down to $4.08, and I still am going to be making a profit. Okay, that's cool. Here's some examples of doing this strategy. 43% on Yandex, 9% on Guess Jeans when the stock went sideways, 2% on Bloomin' Brands. That's the Outback when the stock took a big dump, and it took a big dump. Okay, so now here's another question. What if we actually want to, more than that profit buffer, we want to drastically reduce our return on risk? How do we do that? Should we sell half as much option premium? Should we sell out in time options? Should we collar the investment by marrying a protective option, or is what I'm talking about not possible? Let's collar this thing. Let's put a married protective option in there. In fact, let me show you an example. I'm going to show you two examples because I want to show you an example. This is on a stock called Ericsson. Ericsson, of course, is a mobile phone company. Or I should say they are a mobile phone component company. You've probably heard of them. They have made mobile phones in the past, but now every mobile phone, whether it be a company like Apple or any of the Android phones out there, they have a little component in them made by Ericsson. So they're a nice, safe company, kind of like GE. Like GE is, if you look around your home, you've probably got a little bit of GE in everything, right? GE is one of these companies that's not going away anytime soon. In fact, those are the companies I look for to do this strategy on, is these companies that aren't going to go away. So this is Ericsson. I want to show you this trade that I did. Here's where we purchased the Ericsson for $8.30. I bought 1,100 shares. I sold the premium for 20 cents. And at the same time, actually, I sold the premium on a Friday evening, and on Monday morning, I bought a protective option, and I paid a nickel for it. The protective option was the $8 put. So I sold the $9 call, and I bought the $8 put for a nickel. So what happened? Well, the 20 cents expired worthless, so I got to keep that 20 cents. And then when I no longer needed to sell that premium, when that premium expired worthless, I went ahead and sold back my put. But I sold back my put at a profit. So I paid 5 cents for that protection. I sold it when I didn't need it again for 25 cents, and I did it all over again. A month later, I sold another premium for 20 cents. This time when I bought the protective option, I didn't get such a good deal. I still paid 20 cents instead of 5 cents. Fast forward a little bit, the option expired worthless, and I sold back. I still made a profit. I made 5 cents profit. I just kept doing this until I got exercised out. In just 3 short months, I made 24%, 23.9% ROI. That's a pretty good example. How about this example from just earlier this year? On February 4th, I was in some Ericsson. Again, this time I was in 2,100 shares at $8.10. I sold my premium, 30 cents, and I bought my protective options for 15 cents. Look at what happened. The stock went down. The stock crashed down. In fact, do I have my, I heard my Thinkorswim ding-donging. There it is. Give me 1 second. I'll just bring you my Ericsson. There he is. And I want to be cognizant of the time, folks, because I don't want to go over here. But let me just show you, ERIC. So as you can see here, let me go to a 6-month chart. Ericsson took a real dump on me. So I still get to keep that premium that I sold. I still got to keep that 30 cents. You could see it expired worthless. I got stopped out of the back month option at 740, but I had that protective put. In fact, I bought that protective put for 15 cents when Ericsson finally bottomed. That 15-cent trade, I sold it for $1.95. It offset any losses that I had in the underlying stock, plus some, where after just a single month of trading, I still walked away with 17.2%, even though the underlying stock took a big giant dump from where I purchased it all the way down to $6, right? So if you're starting to see the power of this, not only do I get my protection, like when the market takes a big dump like it did a couple months ago, but also look at what happens when the sideways trade just continues going sideways. I get to sell back that protective option at a profit every month. It adds to the economics of the trade. I'm not hedging my symbols at a loss. I'm actually creating yet another source of profit to the overall position. And I'm only, if you look at these dates, I'm only doing transactions, like 2 transactions per position per month, right? It's not a lot of work. I'm not day trading. It's like 2 transactions a month. But look at this other thing. Notice my cost basis. So when I start off, this cost basis includes commissions. So when I bought my stock, my cost basis, including commissions, was a penny more. Then I sold my premium. Look at what happens after just the first month of trading. Notice that my cost basis dipped down below $8. How much am I protecting? My strike price is at $8 for my protective put. So what does it mean? Ask yourself what it means when my cost basis after just one cycle is below the amount I'm insuring it for. A couple of more trades here, 8% when the stock went up, 24% when the stock went sideways, 13% when the stock took a big dump. Take a look at this right here, because this is actually Ericsson. So let me just pull up a marker really quick. Notice on this graph that right here is the 0 break-even line. This is a -20, this is 30. Notice we've got range low and range high. That's because these are range-bound trading strategies. That means so long as you stay in the range, this is what happens. Here's what I want you to notice, because most of our trades last about 5 months before they either get pushed to the downside, called bailing out, or pushed to the upside, called being exercised, right? This is being exercised. This is being bailed out. Notice what happens between month 1 and month 2. Getting bailed out, in other words, having the trade go sour, actually results in a profit. And the longer you go, here we get back to that whole penny versus $50,000. the longer you go, the more consistent you go, you get to a point where the trade can go sour against you and you don't even frickin' care, because whether it gets exercised and you wind up getting 50% or you get bailed out, you still wind up with a minimum reward of like 45%. In fact, a lot of our trades go even longer than 5 months, 6 or 7 months, and you can see how the compounding really kicks in on these trades the longer you hold them, just being consistent, right? You don't even care if the trade goes against you, because the difference between the trade going against you in profit and the trade going for you in profit, in fact, the word against you doesn't even mean anything, because having the trade be going down to the downside winds up giving you just as much profit as if it goes to the upside. Here's where, who cares what your win-loss ratio is? Because even if you lose, you get a big chunk of change. Does that make sense? That's the beauty of letting time work for you on these option trades. Okay. So what do we have when our cost basis, our break-even price, is less than where we have our protective bailout price? Is it a risk-free investment? Is it a losing trade? Is it too much complexity? Is it a pipe dream? If you're saying to yourself, it's a risk-free investment, the minute I'm insuring my position for more money than I have in it, that means by definition, it's risk-free. I got none of my own money on the table, and you're absolutely right. So let's review what these 3 steps are. Step 1, you're going to buy or you're going to short an underlying security, or even better, you're going to buy a substitute option trading at parity. Step 2, you're going to sell a near-term at-the-money option for its premium value. It's called an instant dividend or a profit buffer. Finally, you're going to collar with a married option that is about 3 to 6 months out in expiration, and that's going to protect your investment. Got those 3 steps? Here it is graphically. Here's a good position. This is ticker BBD. So at the bottom, this is called legging in, and this is even better than doing a buy right. So at the bottom of a channel, we like to buy our underlying or our call option trading at parity, and we'll put a stop loss order in place at this time. When it hits a top, that's when we're going to sell our near-term call option, and at the same time, we're going to buy our protective put option. As time goes by, that near-term call option expires worthless, and at the next bottom, we sell back the 3 to 6 month out put option for a profit, and rinse and repeat, rinse and repeat. And as we talked about, you can do the same thing the other way. In other words, if a top is what's coming next, then we'll short an underlying, that's a margin trade, or we'll buy the put option trading at parity, that's a cash trade. And again, we'll put a buy to close stop loss order up at the top there. At the bottom, we'll sell the near-term put option, and we'll buy the 3 to 6 month out call option trading at parity. We'll buy the 3 to 6 month out call option as protection, I should say. That near-term put option expires worthless, and at the next time, we sell that that protective call option, and we repeat, repeat, repeat. Write down these symbols. I just reviewed these symbols last night. They're worth you going from this presentation and checking them out. GE, Caterpillar, US Bank, Nordstrom, Rite Aid, Edgewell, Ericsson. All right. How would you like to never miss a pick, Minimize the amount of time that you spend away from your loved ones, and most importantly, have support whenever you need it doing this strategy. Because that's what it's all about, right? It's about saving time, creating clarity, and getting results. I'm talking about profits. So I'd like to ask, would it be okay if I take a couple moments towards the end of this presentation to tell you a little bit about my materials, my training and tools, just to see if they might be right for you? Cool. Thanks. So this is for someone, see if you check any of these off your list, who doesn't want to pay for a lot of data subscriptions, wants everything they need in one place, doesn't want to miss any opportunities, wants to spend more time doing other things than staring at the computer trading, doesn't want to be doing this alone, and wants some step-by-step instructions. In other words, this is for someone who wants to get consistent, reliable results. Is that you? Let me just tell you about Charlene really quick, because I do have a few minutes. I want to take this opportunity. This is an email I got at 2:10 in the morning, right? I want to take this opportunity to tell my story. So Charlene was a teacher, and I think teachers are the most underappreciated profession out there. I mean, after all, they're the ones who are making the next generations prepared for our society, right? And yet we treat them really crappy. She had been a teacher for 29 years. She got sick. She didn't say it in her email, but she got cancer. And she stuck on, but with all the chemo treatments, she was ordered out of the classroom when she just couldn't, you know, she would show up to work and she just wasn't able to physically do it anymore. So they actually ordered her out of the classroom. She was 13 years left before she could get her pension. And she actually thought she was going to pass away, and she was peaceful about it. And then this is what really sucks about what's happening in the world right now. She had a miraculous recovery, and you would think that's a time for celebration, but what it really means is now you're alive and you have a ton of medical bills. She had no livable retirement coming in. She wouldn't be able to collect Social Security for 10 more years. She got interested in the stock market. The rest was history. Thanks to AJ, she's not only going to make a living, she's actually going to be able to travel. What's better than that? All you need to do is read. So what she's talking about here, let me actually, if you log into the actual user's web portal, you'll notice in our menu here, under trading tools, we have this thing called the premium selling screener. I created a tool that goes through every stock, option, and index and ETF, and it matches them all up. And so it screens through every evening. You can see this was last night, this was the night before, and it looks for tickers that might be high probability symbols, right? Tells you buy this stock, sell this call. This little screener is pretty awesome. And last night, for instance, it went through about 12,000 underlying security and close to 1 million options. You know that each underlying security has quite a few options associated, and it just looks for ones that you can match together. So she's talking about in her slide, all you do is read the daily table, find a stock you're interested in, follow the strategy set out for you. I use this along with other strategies to diversify my financial plan. I recently made 14% by just spending about 15 minutes reading about the company, following the chart, and then waiting for expiration. So we love Charlene. She's been with us for years. So let's see. What else is part of it? You get to be part of our weekly workshop. In fact, it's every Thursday. We're having one this evening at 9 p.m. Eastern time, 6 p.m. Pacific time. And this is where we actually take you through the hand. We give you this spreadsheet. It's a little tool we give out all of our users. You could take it home with you. You fill out the blanks from your trading software, whether it be Thinkorswim or Charles Schwab or whatever platform. You fill in just the numbers. Like, it's very nice. It says, tell me about the option for our model. select near term. So it tells you exactly what to do. And look at what it does. Down at the bottom, there are our 4 strategies that we talked about. Here's the cover call, and it tells you your plan. It even does your risk management. It makes it so that you don't be one of those folks that does those 2 common errors, right? Go long 400 shares of GE after bottom has been found tells you exactly what price. Make sure you pay less than $11.77. Place your conditional bailout trade. Write 4 contracts of GE near term at the money call. Whether it's a covered call, a covered put, the bull call diagonal setup, there's your plan, right? It tells you exactly what to do. And we fill those plans out once a week. That helps people learn how to use the tools. But at the same time, at the end of every weekly webinar, like tonight, you'll get a ticker that we have vetted for you that you can go off and trade the next week. The other cool thing that we have in our program is getting your questions answered. So a lot of times you get into some of these programs and you don't hear from the person ever again. Check this out. So I'm back at our member site. I go up here to support. And when I click on support, it says, do you want to ask a general support question or ask a trading question? And if you ask a trading question, you find this little screen here with Buddha AJ. He's meditating there. This is me from 13 years ago. I haven't had pictures taken since, so I like to look at him because he looks really young. And you ask me your questions, and you can attach screenshots, you can attach your spreadsheets, and I'll review your trades. In fact, I want you to do that. I want to make sure, whether it's a paper trade or a real money trade, but especially if it's your real money trade, I want to look over it for you so that you don't do anything silly. So you send it to me, and I'll make sure before the next trading day that I answer you and make sure you're not about to invest in something that's going to go against you, right? So that's kind of cool too, right? I also have a double your money back guarantee. What does this mean? Do my program for 6 months, and if at the end of the 6 months you're not making money, if you're not profiting, now you have to do exactly what the program says. You can't go off and do your own thing. But if it's not working for you at the end of 6 months, if it didn't work for you, not only will I give you the money you pay on this program, I'll double it, right? That's how confident I am this works. So this is how you take care of it. You go right now, optioninvesting.org/special. If you have a mobile device, you can just scan your screen with that QR code. It's going to bring you to a website that looks like this. Here's optioninvesting.org/special. And you scroll on down. It tells you everything you get with the program. The price is $497. That's for 6 months. There's no additional prices or anything like that. Here's the description of the guarantee. $497 for 6 months. You can pay by PayPal. You can pay by credit card. Go right there. Don't pass go. Don't collect $200. I love that little Monopoly guy. You deserve this. If you're ready for this, if you've got the time to put into this and learn how to do it, use my tools, my spreadsheets, my scanners, my screeners, my step-by-step quick start guides. Now's the time. Be on the right side of the equation. Wall Street is paying out heavily to the folks that are on the right side of the equation, and it's taking money from the people who are on the wrong side. Make sure you're on the right side. Not only do you deserve it, your loved ones deserve it too. If you have any sort of questions, you could always reach out to me. Those are my phone numbers and my emails account. And I'm just at the end of my hour. So I really appreciate you guys listening to me this morning. I've had a great time. Go visit me at optioninvesting.org/special. Thanks.
Thank you so much, AJ. It was a wonderful presentation.
Thank you.
So for those of you guys that are interested,